Well, folks, now we have to analyze three potential scenarios for recession. We're going to look at BNP Paribas and their piece on three scenarios for recession, but we're also going to, in this, talk about what China could be doing. Is China going to help us out of a recession? What parts of China are going to potentially benefit? And are there any potential stocks that could benefit from China's reopening in America? Lot to talk about. Do keep in mind this video is brought to you by, and everything on my channel is brought to you by, those programs on Building Your Wealth linked down below. You can go to meetkevin.com, see anything about my ETF, my affiliate links, my courses, but most importantly, check out that 69% off coupon code for CPI Day that has prices going up on April 12th. I'd be excited to have you there. We have fundamental analysis live streams almost every day that the market is open, Q&A in all of the courses via our live streams, the exclusive group, and the elite hustlers. Most popular courses right now are the Zero to Millionaire Real Estate Investing course, the Stocks and Psychology of Money group. A lot of people are bundling those together. And then some people even go as far as triple bundling with the elite hustlers. A lot of people who just like real estate end up going for Zero to Millionaire and then do-it-yourself property management and rental renovations program. But check out all of those linked down below, especially if you're looking to build your wealth and your income. Okay, so the first piece that we need to talk about is the three recessionary scenarios. So let's jump in over here to exactly these scenarios, and we'll also go ahead and to make things a little less disruptive, just throw up a banner to continue to remind you about that coupon code. All right, here we go. So hike in May, then go away, says BNP Paribas. To gauge the degree of political substitution, we modeled three scenarios based on a risk premia. Okay, in English, three scenarios in terms of what can happen with a recession, all right, and the fallout. They, by the way, see a terminal rate of 5.25%. That terminal rate for them is down from 5.75% because of the banking crisis. Now, they also argue for 175 basis points of cuts in 2024. So that is pretty aggressive tightening. And remember in my video that I titled The Most Important Fed Video Ever, I encourage you watch that. You definitely watch that if you haven't yet. We talked about how the more aggressive the cuts, the better it could actually be for the stock market. Now, that sounds intuitive, but preemptive cuts, like small little itty-bitty cuts, are usually ones that still have painful stock pivots ahead, whereas large cuts can be a very good way to sort of turn the money printer back on and set sort of a floor under the recession. Now, the composition of financial conditions and tightening are noteworthy. They talk about credit spreads. It's not so important to understand what they wrote there. It's more important to look at the conclusions that they have. So the first conclusions that they make or tools that they use to get to their conclusions, because we're going to look at the three different scenarios. The first is that they look at surveyed lending standards already at recession consistent levels. Now, this is a little bit problematic because at first, through the banking crisis, we didn't actually see a big spike in tightening lending conditions, but we have started to see those. I drew these red horizontal lines to show you baseline. And basically, when you go back to the dot-com era, that's when you see both the blue and the green above the red, both red lines. And then, of course, the 2008 recession, you see both above. And then generally in between, you have this decline, right? Loosening credit standards. This is when credit is more available. This is when more people can take on loans. They spend more, earnings per share go up, growth goes up. And what do you don't have? A recession. However, and then of course we had briefly COVID over here, very brief, but look at where we are again here. We are clearly tightening again in a recessionary level of both types of or both measures of tightening standards and the availability of loans. This is obviously consistent with the inverted yield curve that we're probably leaning to a recession. Now, hard landing data points, so hard landing, or sorry, hello, it's too early to read. Hard lending data points point to further softening. And so what they show here actually is what happened during the banking crisis. First of all, you could see the trend of lending data. Look at the trend. The trend of lending data has been straight down. Now, some people make the argument that maybe this right here, this plummet in lending data, was transitory stress because of the banking crisis. And that transitoriness is proven by the rebound here. But the further argument that people make, which is quite interesting, is the following. They argue that what if We had this spike on the right because people like Meet Kevin started making videos during the banking crisis. Yes, I am patting myself on the back, saying you should draw down your lines of credit because banks might start freezing them if this banking crisis continues. Remember what happened in 2008? In 2008, when the financial crisis hit and the financial crisis stayed, banks froze lines of credit. That could hurt working capital at warehouses. It could hurt credit card borrowing ability, your home equity line of credit, your rental property line of credit, your margin line of credit. All that stuff could get frozen. And then you don't have access to that capital anymore. So during a banking crisis, it's very common for people now to just draw down on their credit lines to minimize the risk that their credit lines get frozen. And so it's possible that you actually saw a spike in lending because of that. So if we take out that spike, it is possible that this downtrend in hard lending data does reiterate that we're walking right into a recession. So there are three scenarios given here. One scenario is the increase, is basically there's the improvement, which basically says that all of the banking stress goes away after 1 quarter, which would mean by June, July, the banking crisis is over. In other words, the banking crisis was transitory. Now, there is a potential that that could end up being true when we specifically look at treasury yields. And you want to pay attention to that. If you want to know if the banking crisis is going to worsen or not, look at treasury yields. Right now, the 10-year is sitting at about 3.4%. When the banking crisis began, the 10-year was sitting at about 4%. So you're looking at about 60 basis points higher. So when yields go down, the value of bonds goes up, which means bank balance sheets look more robust, lower chance of a continuation of a banking crisis. However, obviously, we are seeing a lot of people move money into money market funds. I actually did a video about where you might be able to go, where you can get savings yields, whether that's through Vanguard or others. But there are plenty of opportunities for you to get somewhere around a 4% yield right now, or more. I mean, you could look at hashtag not sponsored, SoFi, Robinhood, Wealthfront, money market funds from Schwab or Vanguard. There's some, or even Fidelity. There's some phenomenal ways you can get 4 to 5% interest on your money, and that's cash yield. It's fantastic, right? Anyway, so banking crisis so far, I think the odds are falling that we're going to continue to see a banking crisis, although I think everybody's still on alert, as is reasonable. Scenario number two is a stabilization. That is, everything basically stays a little nervous for about 1 year. Now, I think it's very interesting how they put this because they basically say, even in an improvement scenario, think about this. Let's translate this. I always like translating stuff to English because sometimes the way they write these things is complicated. So in the good scenario, 1 quarter of pain. Okay. In the medium scenario, you have 1 year of pain. In the bad scenario, let's see, we haven't talked about the bad scenario yet. In the bad scenario, they assume that equity prices could decline the equivalent to half of the move experienced during the global financial crisis. Well, that's not fantastic because if we zoom out on the S&P 500, we know that the S&P 500 went from about 152 down about 50%. So they're basically making the argument here that if the banking crisis gets worse, you could potentially see a negative 25% move to the S&P 500. Now, remember when I put ticker symbol SPY up, that's not sponsored. SPY is just a very common vehicle that people use to invest in the S&P 500, as well as if you want the NASDAQ. I highly encourage you use QQQM as opposed to QQQ. It's the same fund with a lot lower fees. Anyway, okay, little freebie there. So growth in all scenarios is lower despite looser monetary policy. Now, this is unfortunately slightly bearish, and we haven't gotten to China yet. So I want to talk obviously about China, and is China going to help us or hurt us? Well, we'll find out. So growth is lower in all scenarios despite looser monetary policy. For real GDP, the 0.8% peak through trough decline in our pre-SVB baseline becomes deeper. So in other words, things become worse. They move the best case scenario to a GDP reduction of 0.9. Or sorry, this is yes, these are likelihood of recession call. Yes, these are the depths. For real GDP, the 0.8% peak to trough decline in their baseline. Okay, so these are the declines in GDP as a result of this banking crisis. So they think that GDP in these various scenarios here, from a baseline estimate, we'll go ahead and call baseline 2%, let's say. So they think you could see baseline move down 0.9% in the improvement scenario, 1.2% in the medium scenario, and then in the deterioration, negative 3.6%. So that would put us, this right here would put us down at negative 1.6% if you come off of a 2% baseline. That's big. That's a deep style recession. And unfortunately, they suggest that we lean towards greater severity here. You could see risks are tilted towards greater severity. So in other words, BNP Paribas is actually more bearish. Now, they do suggest that inflation could return to target earlier than expected. Their original target was Q3 24, but they think that inflation is going to deteriorate much faster. But unfortunately, the damage to the economy could be a lot greater, which is not great, obviously. So that does potentially knock us on the door of recession. Actually, you could see here in their various different scenarios, this is their GDP forecast for Q4. So that's taking the minuses off of their baseline. So they think that by Q4, we could be in a recession in all scenarios. In all scenarios, they're looking at negative here. And they think that in the good scenario, we are going to see the Fed cut by about a quarter, maybe that's about 10 basis points at the mid, maybe 1 to 2 times in the stabilization scenario. But if things really hit the fan, 2%, 200 basis points of cuts. And again, they see risks tilted to the downside. So again, I always like to report the bear sides as well. And I want to talk to you about China because this is going to be very important to talk about China. But I like to talk about the bear pieces, not because I am bearish. I still believe heavily in the Nike swoosh recovery. The Nike swoosh, remember, is rapid down and then very, very long-term swoosh up, but also very volatile. So a lot of this up and down will be very, very expected. But so far, we are on this trend. We have begun this trend. Hopefully, we maintain that. But obviously, in their bearish scenario, that would vanish. So now let's talk about China and some stocks that could benefit from China in this potential cycle here. So the first thing that we should look at is China and some of the recent news that has been going on, and then I want to talk about some stocks. So first, obviously, we just had House Speaker Kevin McCarthy meet with the president of Taiwan. Now, remember, this followed in August Nancy Pelosi visiting Taiwan directly. Now, the Speaker of the House is a really important position because you're the third position from the presidency. And obviously, China wants to reunite Taiwan with China. And Taiwan's like, F you, we don't want to be Chinese. We like capitalism. So we're our own independent country. And the more the United States recognizes Taiwan, the more it potentially inflames issues in China or the Chinese political regime. Although China has been very, I have to say, and I am not like a big proponent of China, but I will say they have become a lot more level-headed. When Nancy Pelosi visited China, oh my God, wake up, Kevin. When Nancy Pelosi visited Taiwan, we saw Beijing freak out with massive military drills that ended up landing missiles in Japanese economic water and Taiwanese water, obviously. This time around, level-headed. Now, back then, they still thought they were in control of the world. In August, they were still under COVID lockdowns. They thought they were perfect. They thought China could do no wrong. China's actually been, I think, recognizing their humility. And I actually give them props for that because since the Chinese Party Congress and the elimination of COVID controls, you've actually seen China become a lot more moderated. They've been moderate from what we can tell in their relationship with Vladimir Putin. They've been more moderate in their relationship with Emmanuel Macron. Now, they have not basically what's the word when you say China don't go to war with Ukraine? They haven't condemned the war in Ukraine, but they've been calling for peace. And they've been doing so with Putin. They've been doing so with Macron of France. They've been doing so with other world leaders. And they've been talking up capitalism more, which, in my opinion, the more you see China talk up capitalism, the lower likelihood China ends up invading Taiwan, because that's more of a communist push, right? We're going to imply or impose communism back on Taiwan. This is insane. And I don't think anybody has said this before, but I'm going to make a projection here. If China continues down the path of enjoying capitalism with, well, we'll call it socialism with hints of capitalism, Elon Musk is going to visit China this weekend, and they're probably going to put Elon Musk on a pedestal, an example of how wonderful capitalism is for China and how great China is a place to do business, because they realize a lot of manufacturers are leaving China because of the COVID lockdowns. I think there's a possibility, and I'm making this projection here, April 8th, 2013. Somebody please put this on a calendar and remind me in 5 years. Kevin made this projection. Hold me accountable. I think it is more likely, if China stays on this capitalism path, that China ends up forging the greatest partnership, capitalistic partnership and trade partnership with Taiwan in a capitalistic and independent way. That is a greater possibility than the possibility that China actually invades Taiwan. I really believe that. So we'll see. We'll have to pay attention to it. But we also want to talk about how this applies to taking us out of recession, the potential for recession in America, right? So we're going to talk about that, and that's how we're going to link this with this BNP Paribas piece here. But I want to give you some baseline here. So obviously, you have these meetings here. There's obviously there are complaints about sanctions and blocking China from getting advanced manufacturing. Then there are complaints that China is just stealing our advanced manufacturing technologies by stealing technologies from ASML. Don't get me wrong, which is a Dutch company. The Netherlands, as we like to say in Europe, though, Holland. Anyway, there's a lot of tension between the countries, right? But then how could potentially China affect our recessionary outlook? Well, Barclays has a piece on this, and I think it's quite interesting. Let's take a look at the Barclays piece here. Look at this. China's recovery is being powered by services demand stimulation rather than straight up stimulus to people, limiting external spillovers. Okay, that's great. So that means less risk of a negative GDP result from China dragging the entire world economy down. While this minimizes the potential benefit to US stocks as a whole, because think about this. If the Chinese are spending more on local services, local restaurants, local hospitality, local travel, then they're not spending so much on American goods necessarily. However, which is not necessarily a boon to American companies. However, it could be a boon to American companies who have a lot of exposure to China, who sell stuff within China. So I wrote down some examples here. Tesla right now sits at about 22%, 22.9% of its sales to China. That could be between the 20 to 30% going into the future. NVIDIA and AMD, 25% of their revenues come from China. Some of that will be getting hit, just like Taiwan Semiconductors or ASML. Some of that will be getting hit. ASML is another company that sells to China, and they will sell 7 to 22 nanometer advanced lithography machines to China. They're not allowed to sell the 3 and 5 nanometer machines. Anyway, that doesn't so much matter. But the point is, there are a lot of companies that have a lot of exposure to China. And Barclays makes the argument that, look, even if we go into recession, there are actually ways that you can expose your portfolio to China without directly having to invest in Chinese stocks to potentially get some upside of investing in China. ASML is another one. Look at Apple, for example. Apple would be another one that gets revenues, obviously, from China, which is fantastic. Now, it'd be fascinating to see if we can get an Apple, maybe if we can get an Apple 10K. Oh, look at this. I happen to have an Apple 10K here. And let's see where some of their revenues come from in China. If we could get a breakdown of revenues, which we probably can pretty quickly. Let's just do a find for China in here. And I'll go ahead and I don't want to cause any kind of epileptic problems, so I won't page through that. We'll go and pull China here in just a moment. But what you can do to find this out, oh, I already found it, 16% Greater China. So what you can do anytime you want to know how much a company sells to a particular country is just look at the 10K, which is just the annual report. And they usually have a segment revenue piece. Look at that, 16% of Apple sales come from China. And now something that I want you to know is that as the dollar weakens, you can actually have a foreign exchange benefit to earnings per share by having exposure to China. Now, remember, when the dollar was strengthening, these companies were losing money due to FX adjustments. Now they are potentially gaining money due to FX adjustments. Max, thank you for mentioning this. You are correct. S-Bucks. Folks, Starbucks has exploded in China. I have not had the balls yet to invest in China, but I'll tell you, this is the Chinese or the Starbucks earnings call over here. I want to see what they mentioned over here in China. This is I just looked through this. Usually we do this in the course member live streams. We go through fundamental analysis like this. But I want to look at all these mentions for China. We continue to grow our store footprint. In Q1, we surpassed 5,500 stores in China. Do keep in mind, they basically doubled their stores in China during COVID. Like they used COVID zero to just build. And we haven't actually seen the revenues from that yet, which is pretty incredible. So you've got some huge Starbucks exposure in China, which makes me very excited about S-Bucks stock. I've been so tempted, but I really want them at like $80. I think their valuation is a little high for coffee, but you know, I'm not trying to downplay them as coffee. Okay, I did drive down into town yesterday just to get myself Starbucks because I'm at like one of these like Mormon hotels, and they don't open the coffee shop as early as I need, and they close it way earlier than I need, so I could basically never get coffee here. And the coffee in the rooms is like it's like Mormon beer. It's worthless. And that's nothing against Mormons, okay? I'm a big fan of Mormons, okay? I've got a designated Mormon. I think they're great people, hardworking people. But I'll tell you, when it comes to coffee, don't rely on the Mormons to get you coffee. But anyway, so point being here, there are some really big opportunities to expose yourself to China without actually exposing yourself to China. And that those are through companies. Now, there are obviously some risks, right? And on that note, I want to talk specifically about this video. This is a video that I'd like to react to when it comes to China. Keep in mind, China's also been meeting with Brazil. They're going all over the place. Oh yeah, here we go. U.S. is pushing China to its own red line. Former Morgan Stanley and some other individuals warn here. So we're going to look at this together as soon as Kevin can figure out exactly how to do that. So while I figure out how to do that, I think it'd be very easy to just say and remind you to check out the programs on Building Your Wealth link down below, because we've got that expiring coupon code on the 12th, and the prices will be going up. Prices trend up over time. So the sooner you get in, the sooner you lock in the best price, guaranteed. Okie dokie. So let's go ahead and remove this, clean this up a little bit. Then we can throw up a banner. Why don't we throw up the StreamYard banner here? Shout out to StreamYard, betkevin.com/StreamYard, where you can record and live stream and throw up all these banners and everything very easily. It's a great software. Okay, so let's listen to this together. So let's see. Let me know if the volume's okay while it's playing or if there are any issues in the chat, please. And let's go.
Our next guest warns the risk of a hot war between the U.S. and China is growing. Yale senior fellow Stephen Roach is the former chairman of Morgan Stanley Asia. He also wrote the book Accidental Conflict, America, China, and the Clash of False Narratives. Stephen, it's always great to get your take on all things China. And I'm wondering how you would, now you're a professor, how you would grade the calculus that was done by Kevin McCarthy in meeting with the Taiwanese president at this moment in time.
Well, Melissa, I think nothing happens by accident in Washington when it comes to China, and the same is true of China with respect to the United States. McCarthy, like his predecessor Nancy Pelosi, there's no big secret as to what the message they're sending, as Guy just indicated. They're offering support for Taiwanese independence. They won't say that explicitly, but that is the not so subtle subtext. And
It's obvious that there's tension between Taiwan and China. That's obvious. We know that. But what I want you to know is when you hear about the Taiwan China FUD that we hear about, what I want you to know about is this article right here. Look at this line right here. The possibility of war in Asia, something that was long unthinkable, has prompted governments and companies to assess their exposure to China. Now, think about that, folks. I want you to think about that for a moment. What does China not want companies to do? This should be obvious. You should know the answer to this. What does China not want companies to do? They don't want companies to leave. So if Bloomberg is saying, dude, the more we escalate fear mongering and war, the more our companies leave. So think about this for a moment. Nancy Pelosi visits Taiwan. China freaks out with all their military drills. Companies start leaving. Then China's like, oh shit, we done effed up. We don't want companies to leave. Okay, let's kill COVID zero. Let's invite companies back. Let's get Elon Musk to come to China. Let's talk about how great capitalism is. And let's stop being so angry against Taiwan. And so when you hear the fear mongering of Taiwan and China and this war, I really want you to think about how many companies are now leaving China, including Apple going to like Indonesia and India. I want you to think about how many companies and how much money China stands to lose just by fear mongering. And the odds of war go down the more fear mongering there is, because the more fear mongering there is, the more companies leave. The more companies leave, the more China's like, okay, we're screwing up. So just think about that as you're listening to this FUD. And I'm not saying it's fake news. There is a very real argument to be made about war between China and Taiwan. But I want you to think about both sides. It's very important. Let's keep listening.
And for China, that is their red line. And they pushed back last August, and they will most assuredly push back after this meeting. It wasn't, quite the same thing, but it clearly raises a real warning flag for them that we're going to keep putting our foot on their throat. I was in China.
See, I disagree with that. I don't think we're putting our foot on their throat. What we're doing is we're promoting capitalism, and China's actually starting to accept that, as they should.
Last week, I was at the same meeting that Tim Cook was at.
Mm-hmm.
And, sure, he was saying positive things about Apple's relations with China because he wants to keep doing business with them in terms of selling products, but also in offshoring production to China at considerable saving to American iPhone addicted consumers. So he's walking a fine line here. And then, the select committee, we know where they're coming from. They want to bash anyone and anything that has anything to do with China. And they will, drag these guys, all the multinationals you just cited, will probably be brought in front of their committee and interrogated, just the way the TikTok CEO was harangued.
And that's not a big deal. That's really not a big deal. Let the CEOs be brought before select committees. This just doesn't matter.
Last week in Washington.
And remember, that TikTok CEO is not the CEO of ByteDance. That TikTok CEO is a puppet.
McCarthy said after this meeting that he believes that there's a bipartisan position on the need to speed up arms deliveries to Taiwan. So, the rhetoric is certainly there, and I don't think that there's any sort of hidden message as to what the intent is when it comes to Taiwan and China, Stephen. When it comes to the multinationals, if you were in the position as you were before to advise these companies, what would you say in terms of, whether or not they should be prepared that they have to pull their business out or in some way pare it back?
Well, a lot of multinationals have made major commitments to China, and they certainly don't want to pull out. But I think at the same time, Melissa, they're in their boardrooms, they're all talking about contingency plans, about hedging their offshore production away from China. Apple's already done that with shifting some iPhone assembly and production to Vietnam and India, a small amount. But I think, all multinationals who have made such a massive commitment to China want to at least begin to work hard on a plan B here.
What is your guess on what the retaliation from China might be? Not only do we have this going, we have also, the hearings on TikTok not that long ago. And so do you think that it would be a hit to U.S. companies in China, or would it be something more along the lines of a sort of like a not a military, but maybe a cyber or something like that, as opposed to on industry?
Well, look, last August, they certainly had a major, probably the single largest PLA military exercise in the Taiwan Straits in years, if not ever. And I think you can.
I actually have an image on that. Let me throw that up. Take a look at this. There we go. There we go. This shows you their military exercise and how missiles landed in economic waters around Taiwan and Japan, and it was a pretty big exercise. But again, we're not seeing that again today. We're seeing a relaxation. I worry that this individual talking at CNBC here is promoting the original China, not this revised China that we've seen over the last only 4 or 5 months. He's talking about the China from 8-9 months ago. And I know it seems crazy that an entire country could flip flop, but something to think about. All right, let's keep going here.
You can look for a similar type of response, maybe not as extreme, maybe just as extreme. We don't know. They have moved aircraft carriers, in the Taiwan Straits, close to the island, and they are reported to have other ships, significant presence of ships in the area as well. And whether or not they move them into the same type of warning position, I have no idea.
Stephen, thank you. Nice to see you. Stephen Roach. It's one thing to move away production out of the country, but you can't move your coffee store out of the country. Right. If that's what you do, you can't move.
Yeah, and we're building more of those over there. Okay, so this gives you more of this sort of traditionalist argument. I think that China has substantially revised since then, and I'm hopeful, and I look to continued new signs of this. So it's worth to note. Now, Deeps here in our chat is making a fair point that China has also warned against or of worst case scenarios. And this is a very realistic point of view as well, that, yeah, we have to keep in mind that we are in a global recessionary time and there are a lot of tensions, but you also have to remember that China has to play to some extent both sides. They have to make the argument that, hey, wait a minute, look, we still love socialism. We still demand our power, and things could get really, really bad. Of course, they have to say that by default. I'll go ahead and play that segment because Mr. Deeps here was very nice to provide insight into that. So let's see if we can play that here.
Potential dangers. Be prepared to deal with worst-case scenarios, and be ready to withstand high winds, choppy waters, and even dangerous storms.
They're making the allusion to, obviously, that, hey, look, we're going through a global transition here, an economic madhouse, right? So anyway, I think it's very interesting. And, what ultimately they want to do, though, and this is my belief, is build out business and prosperity for companies, because that's going to help them lead to their ultimate goal of common prosperity. And so remember, for example, when China took over solar panel production, when they really started solar panel production back in I think it was around 2013, they not only now today make the most solar panels, but they make the best solar panels. Something to watch for. So let's listen to this segment as well. This is a pretty interesting piece. This gives you just a little bit of a contrast, also from the 20th Party Congress. This was in about, I think it was November. Anyway, let's listen.
World in terms of grain output, China's manufacturing sectors, it's the largest in the world, as are its foreign exchange reserves. We have made breakthroughs in some core technologies in key fields and boosted emerging strategic industries. We have witnessed major success in multiple fronts, including manned spaceflight, lunar and Martian exploration.
Whatever. I mean, the whole thing is a lot of just Chinese prop. But the point of showing that is to show that, yes, you can obviously show the bear case scenario. Obviously, we know that. And we could say, yes, this would be bad for companies with exposure to China. But when we consider the transition of their recent actions and their recent speeches, bragging about capitalism, bragging about Elon Musk and Shanghai, look, for example, you really only have to go to the South China Sun Post. They really show you that. Here, I'll just pull it up really quick. They give my favorite example here, and the example that they give, if I could find the darn thing, the example they give is they show how manufacturing in China succeeds, and they use Tesla as an example. And that's one of the reasons why Elon going to China is so powerful right now, because you're really highlighting that China doesn't want to go to war. They want more manufacturing here. It's one of the reasons they ended COVID zero. It's one of the reasons they are being more neutral in response to this reaction of the president of Taiwan coming to visit Kevin McCarthy, more neutral in the face of Ukraine, balanced with Russia, balanced with France, balanced with Brazil. Now, don't take it from me. Listen to yourself to the latest actions that China is taking. And when we do that, I think the FUD that comes out of China is a little excessive. And I think it's unlikely that there's going to be a war between the two. I actually think it's much higher. There's a higher likelihood that China ends up helping us grow GDP. And now, of course, look, we know that a lot of people were hoping that China's reopening was really going to help commodity prices pop up. So far, that hasn't happened. For example, here's a piece from JP Morgan showing that, hey, China's dodging the global inflation that we're seeing, but we're not seeing commodity price boosts. Instead, somehow we're able to maximize growth with goods and services. So you have sort of localized travel inflation, but not exported inflation. No major issues in terms of inflationary dynamics affecting global inflation, which is fantastic. You've got an inflection point in Chinese real estate, with finally a bottom being found at companies like Evergrande and other companies affected by the real estate burst that we've seen. And that's not to say that China is perfect. I don't want to sound like a Chinese apologist here by any means. The idea is simply to say that making bets on a war between China and Taiwan, I think, are your edge case scenario. I think you're probably looking at more of a, let's say, 5 to 10% chance rather than a base case that we're going to see war. Okay, now just to add a little bit more clarity on China, take a look at this Goldman Sachs research here from April, so just about within the last week here. Both services PMI and construction PMIs have reached their highest levels in China since 2012. Government-led infrastructure building remains robust, suggesting policymakers are more patient than in previous cycles and are unlikely to withdraw support. And take a look at this. On Monday, March 27th, First Vice Premier of China said that China's development forum, that opening up is China's basic national policy. See, this is the recent rhetoric from China you want to be paying attention to, not the fear rhetoric, because this is the most recent. Look at the most recent to highlight what they're doing. They are launching a ceremony of, quote, Invest in China events. They're calling 2023 the year of Invest in China. And no matter how the international situation changes, China will, quote, only open its door wider and wider. This is fantastic. We're seeing Tesla China sales increase. We're not only seeing Tesla China sales increase, but take a look at this. We are seeing manufacturing activity start surging again at the removal of COVID zero, which is also fantastic. We have more data and research here as well. Let me see, what is this one here? Trade volume returning back to trend, even though China is losing a share of US imported manufacturing products. They're trying to get back to these levels. The piece that I was talking about with China encouraging foreign development, this was great. South China Morning Post. Now, I actually subscribe to them, even though I know they're Chinese propaganda. But I do that because I love looking at what they're propagandizing. And what they're doing is they're taking people like Elon Musk and they're putting him on a pedestal. Look at this. The premier, former Shanghai party boss, who was poised to take over the premiership, he did, during the upcoming reshuffle, he took over. He says the following. The directive in China is, quote, to facilitate the launch of landmark foreign-funded projects, calling to mind what happened in Shanghai with the, quote, Tesla Gigafactory, which was one of the premier's largest achievements during his term in Shanghai. Whether more projects like this will be launched is something we should look forward to. So compare the recent rhetoric to the old rhetoric. China, see, look at this. According to a survey of the American Chamber of Commerce in China last week, for the first time in 25 years, China was no longer considered by most of its member companies to be a top 3 investment destination. China's waking up. They're realizing they done screwed up. So when you hear the FUD in China, come to meet Kevin for at least the other side of the perspective, that maybe this war perspective is overblown and that not investing with exposure to China could be a big mistake. Now, again, I don't invest in Chinese stocks. I invest in American companies that get my exposure to China for me. Like example, you invest in Apple, you're getting 16% exposure to China. Fantastic way to do it. The more China wins, and tries to compete for manufacturing dollars, the cheaper it becomes to manufacture in China, and the better the win is for companies like Tesla in China, or Tesla and Apple, or Nvidia or other companies. So I'm a big fan. Anyway, that officially concludes my piece. Bye now.